Hi, welcome everyone, and thank you for joining us today. Our presenter is Max Fonarev, founder and chief valuation officer at Sorbus Advisors. Max is a valuation specialist with more than 20 years of experience. He works with clients from a wide range of industries, from early stage startups to mature private and public businesses, with a particular focus on valuations for financial reporting and tax compliance. Today, Max will discuss the new valuation guidance for privately held securities and the practical considerations for companies, their boards, and their advisors. Max, thank you for being here. I'll turn it over to you.
Thank you, Brenda. I'll take it from here. Thank you, everyone, for joining. Um, Before we begin, a little bit of a background for Sorbus Advisors. Our firm was founded in 2008. We specialize in valuations for financial reporting and tax compliance. On financial reporting side, we cover all the fair value needs that our clients might have in regards to their financial reporting requirements. It includes business interests, intangible asset valuations, and financial instruments. In terms of intangible asset valuations, we maintain an independent and complementary at this point benchmarking database, bench805.com. On the tax side, we work with corporations as well as individuals. For corporate clients, we value companies for QSBS purposes, corporate restructuring, and intangible assets. For individuals, we perform estate and gift tax valuations, personal goodwill, carried interest, and other types of valuations. So today we will talk about 409A valuations. So that's one of our service lines. So in today's discussion, I will first go over briefly the history of valuation guidance. We'll talk about this current update and the genesis, what precipitated this new updated guidance. We'll cover our valuation methodologies and talk specifically about things that changed, such as guidance around secondary transactions, changes to option pricing method, DLOM, and then, of course, closing thoughts after that. So first, polling question, if you'd be so kind to answer. So thank you so much. Looks like we have about an equal mix of in-house finance executives and valuation specialists. So let's start with a brief history. So for 9A valuations, first, let me mention that when we say 409A valuation, that implies a very specific sort of valuation engagement. Typically, to procure a valuation report from the valuation specialist, clients have to identify or determine two things. One is what is specifically being valued, and second, for what purpose. A lot of times we see clients talk to us about 409A valuations, but it's anything but. 409A valuation, therefore, is a section of the Internal Revenue Code. It deals with stock-based compensation, and it values that stock or private company security that needs to be valued, and individual security at that. So very narrow definition here. Throughout this presentation, we'll talk about valuations as though it's a 498 valuation, but really this will be applicable to any exercise where private company security needs to be valued. Now, the 498 came out in 2004, shortly after the financial reporting guidance came out. At the time, it was called FAS 123R, and now it's ASC 718. The premise of both of those documents was the same, that for financial or tax reporting purposes, you have to look at the value of the stock or value of the stock option on a fair value or fair market value basis. In other words, you can't apply the rule of thumb. You can't apply some kind of notional formulaic calculation. And it's certainly not something that, let's say, company or board elected to identify as the value of this particular security. So the fair value part of it here is that you have to really determine what the willing buyer, willing seller are able to accept as the price in that transaction. I started at KPMG in 2005, and so I saw that pretty quickly valuation firms started using basically the correct approach to valuing these instruments. And so at the core of this analysis is the option pricing method or option pricing models that had to be used. The guidance in 2013 in many ways clarified and made this guidance to be specific as something that valuation world could reference. But in many ways, it had already been the practice at that time to do foreign valuations the way you typically see them these days. In 2016, the portfolio valuation guidance came out. So it was supposed to deal with, or it dealt with portfolio investments and portfolio holdings, but a very large part of the 600-page document was still dedicated to privately held equity securities. And so a lot of clarifications that took place there were applicable to 409A. One of the key elements of that guidance was really the focus on so-called calibration. In other words, if you have an observable transaction, you have to first make your financial model reconcile to that transaction, and then you kind of go from there. In 2024, the initial guidance was updated, or specifically actually just chapters 8 and 9. Chapters 8 and 9 dealt with secondary transactions. So secondary transactions is the transaction in those private equity securities that took place after they were issued between private parties. And this guidance that we're going to talk about, 2025, really of course, is based on the experience that was accumulated in the 409A world over all these years, but it also and primarily was issued in response really to the increase in the secondary market transactions. So here's probably just one of the charts that show the significant explosion of secondary market transactions over the last 12 years or so, about 5 times more than it was in 2013 when the initial guidance came out. The increase in secondary transactions, it's intuitive in many ways. Companies are staying private longer. There's a lot more private capital available. At the same time, market participants, investors, employees, executives, what have you, they also need liquidity before the company actually exits, let's say in the IPO. And so therefore, there is a significant increase. The interesting thing about this increase from the 409A standpoint is that in 2013, you just had this theoretical financial model that you follow and came up with some kind of value. This value was typically higher than the rules of thumb that were used prior to 2004 guidances. Back then, 10% of the preferred price was typically a starting point when setting the exercise prices for stock options. But as those transactions increase in volume, there were more and more kind of observable data points to see what the common stock should really be worth, because the observable transactions typically takes precedence over theoretical calculation. So SEC and PCAOB started noticing that now a while ago, and they started asking questions. So if you have a secondary transaction, why isn't that price is just that price that you use to grant stock options? Like, why do all this 409A valuation? And so, of course, there is good reasons for that, but that was sort of the starting point of that discussion. And so the secondary transactions started to kind of illustrate this disconnect between what the market wants to do and what the theory of 409A valuation tells us. Why is it happening? The guidance kind of not touches, but discusses those points, certainly. So for one of the issues here is that investors frequently look at their venture investments differently from how 409A models interpret those investments. So especially when you deal with early stage companies, then very frequently for investor, it's a binary outlook. So the company is either going to succeed or it's going to fail. And so you're either going to lose all your money or you're going to get the significant payout. So, depending on what statistic you heard about, but in the portfolio of 20 startups, maybe one of them or two of them, if you like, it will succeed spectacularly. You may get some money back from another few, and then the rest of them fail. Now, when you look at the 409A evaluation, the model at the core of that analysis, the option pricing model, really gives a lot of weight to those intermediate scenarios. So to the scenarios where investor can get part of the liquidation preference back. And so the story that your 409A evaluation tells us is somewhat different from what investors might expect. There was also a commentary about inconsistency of assumptions used in the option pricing method relative to the reality. So for example, very frequently we see 409A analyses with, let's say, 3 years before a company exits, with relatively low volatility based on the publicly traded companies. Both of those assumptions, those are principal assumptions that drive option pricing method. Both of them, guidance are telling us, is not necessarily consistent with the reality when we have companies staying, private for a decade or longer. So once you start adjusting those assumptions to the longer term or higher volatility, then the value of that liquidation preference is going to drop, and the value of the common is going to grow. So it looks like we have a pretty sophisticated audience here, so I'm not going to dwell very much on the process of 409A evaluation here. But in classic terms, you have to value the company. You use some kind of allocation methodology. So you value the company. Well, actually, you subtract debt. You end up with the total value of equity. You can use the option pricing method. You can do some kind of scenario analysis, or you can calculate the value of individual security on a fully diluted basis. cases. Here for valuation specialists, the interesting tidbit is that they did away with PWARM as the term, and now it's going to be called scenario-based method. But so after the second step, you end up with what I'd like to think about as an intrinsic value of that security that reflects expected cash flows that that security can expect from that investment. But now, of course, the security is not freely traded, and so the theory goes that the market participant would want some discount because security is not available for immediate sale. Now, this methodology, and it's highlighted here, hello. Hello, I hope everybody can hear me. There was a slight technical glitch. Okay. So I had a small glitch here. Please let me know in the Q&A if you can't hear me. But so essentially here in the box on the top, it's again the traditional approach to 409A valuation. Of course, it's not just that every time, and in some cases, in the minority of cases, people would use either the scenario-based analysis or PWARM analysis, or they would add a scenario of, let's say, a successful exit, such as IPO. And of course, secondary transactions would typically get a minimal weight here. Now, the guidance essentially, it doesn't say that any of those methods are wrong. It more or less wants to adjust certain assumptions, and it wants to consider other scenarios or give more weight to other scenarios. And so here, we take this box, we reduce the weight of that box. There will still be some adjustments to OPM. There will be still some adjustments to DLOM, but the guidance wants to pay more attention to the exit scenario, and in that successful exit scenario, in line with how investors might be looking at their investment. And of course, the guidance would want materially greater weight given to the secondary transaction. So on the right-hand side here, you see this box. It's squares because in the positive exit scenario, let's say an IPO, the allocation is based on the number of shares you hold, whereas in the traditional OPM analysis, the allocation is based on value, but that value, and we'll see it in the next slide, or actually 2 slides later, suffers from an undue weight given to the liquidation preference. So I'll start with secondary transactions. Secondary transactions here, because it's essentially culprit of this update. And so the logic of this update is such. So we have secondary transactions that provide us an independent measure of what the common stock value should be. Typically, that secondary transaction is higher in value. And our theoretical 409A model tends to understate the value of those securities. Therefore, the logic goes that the 409A model has to be adjusted because we have an observable transaction, and based on the definition of fair market value or fair value, is really the
price that's paid in the actual transaction for a 409A model to predict it's up to 409A model to predict the price of the secondary transaction and not the other way around, not to pull weight from the secondary transaction as it's observed. So the starting point, before the guidance, the starting point very frequently was just 0. Let's see, we include secondary transaction, we're not going to include secondary transaction. But after this guidance, really the starting point is, okay, if we have a secondary transaction, then tell us why this is not, tell us why we need a 409A report. Why can't we use the secondary transaction as the only indication of value? Now, the reality, of course, is that it's very rarely going to be 100% weight. And for that, this stock has to be actively traded somewhere on the market. But what the guidance wants us now to do is to review very carefully all the secondary transactions and provide the very specific reasons why we exclude those transactions or we give them some lower weight. Now, the guidance doesn't have and wouldn't really have any specific table that would tell us, how much weight to give to that transaction in any particular situation, for one reason, of course, being that there's just an endless number of reasons and facts and circumstances that need to be considered. But it's safe to say that, again, if you have a relatively regular sale of this security on some kind of secondary market, then it's more likely than not you're going to have to just give it 100% weight. Now, from there, when you think about secondary transactions, it's really informative to go back to the ASC 820 in financial reporting and see how this guidance talks about fair value and how it defines fair value. So essentially, for us to observe and say, okay, this price is the fair value, the transaction has to be orderly. Orderly transaction, that's a terminology in that guidance. Orderly transaction is a transaction that takes place in the principal market and generally not under any kind of duress. Now, the principal market might imply that they want some kind of structured market, but it's not. So the principal market is essentially talks about not so much where, but how would you sell that stock. So in ASC 820, the principal market is the market where you can get the highest price at the lowest cost to transact in that security. And so principal market, for example, if you just have a handful of transactions between some private parties, it could be what they call this principal to principal market. So let's say if you want to sell your shares, there's no active secondary market, there's no sort of exchange to go to, but you have to go to your private network of individuals and find a buyer. And so that would still be called the principal market. Now, the factors that you consider here would be the frequency of the transactions. So the more frequent they are, the more weight you have to give to those transactions. There has to be some kind of consistency in pricing. And so not just the pricing has to be volatile, but it also has to kind of reflect the reality of the situation for the company. So for example, if you have repeating transactions at the same price over the course of 3 years, with all those different things happening to the company, then that's probably not a good price to rely upon. But if you have this pricing that reflects, let's say, rounds of financing or milestones company achieved, then that pricing gets more weight in this analysis. Closeness to the valuation date is important, as well as the overall significance of the transaction. So you can yourself create some kind of your proprietary grid, let's say, and then rank each transaction along those axes. Now you might say, okay, there was a secondary transaction, it was 6 months ago, but things changed, and so I'm not going to use it. What they actually want you to do is to adjust that pricing so that you can use it. And so one of the examples is, of course, if the trade took place in, let's say, Series A stock, but you need to value common stock. And so therefore, you have a model that would allow you to actually anchor your analysis in the transaction price for the Series A stock and come up with the value of the common stock. Or let's say the market shifted, or maybe the company raised another round of financing. And so you can use those data points to actually adjust the legacy data point so that it can be used. In other words, you cannot just discard it because, it was, things happened since that transaction. You have to attempt to adjust the pricing. Now, what can disqualify secondary transactions, and actually those factors are very prevalent, but one of these factors that we see most of the time is the price includes some form of compensation to the executive. So they get to sell their shares back to the company or maybe back to the VC at the elevated price because they also get some kind of bonus, let's say for performance or something like that. Now, you have to deal with this argument carefully because this actually has consequences for that executive relative to their tax filing and their tax liability. So typically this argument, you cannot make it in the vacuum. This is something that you should be able to find this type of logic being used in other parts of the tax reporting for that executive. Now, another, of course, a factor that would allow you to disqualify the transaction, it has to do with unit of account, more or less. But if there's other things bundled with that sale of stock, and so the first point here was a bundle, but then you might have, let's say, a strategic investor who buys the stock, but also get access to information or gets access to technology of that company. Or let's say they also assume some kind of obligation with that contract. So for example, it's an employment contract that gets signed. And then, of course, if there's transactions are not orderly, so the transactions, if transaction is rushed, if there is legal obligation, the seller has to quickly dispose of the shares. Those types of things may build the case for excluding those transactions. Now, the lack of information, according to this guidance, is not the reason to exclude a transaction. They still want you to give it some weight if you don't know what has happened. So if all you know that certain number of shares traded at a certain price, you don't know anything else, of course you would use some kind of reduced weighting, but that weighting would have to be there to a certain extent. So we talked about secondary transactions. Again, many of the 409A valuations will not have secondary transactions to worry about, but unfortunately, those clients or those valuations that dealt with secondary transactions illustrated the fact that 409A model might potentially be understating the value of the common. And so what do we do with this traditional 409A analysis so those problems don't, so we eliminate those problems? Now, again, I want to mention here that while we're generally talking about assumptions that would push the common stock price up, please don't expect automatically your valuation to go up because it's very facts and circumstances dependent. It's just this new guidance. Start kind of looking at other factors that you may or may not have to consider going forward, or let's say with your next valuation. But so what's wrong with the OPM? OPM as a model, mathematics of OPM is not problematic. It's just that it doesn't apply in that many situations. Essentially, what OPM the story that the OPM model tells us, or the scenario that it relies upon, is that, let's say you raise Series A or Series B, you have 3 years, and then you're required to liquidate the company no matter what. And so that's not really the reality, right? So first of all, company is going to try to raise more funds to grow. Or the company, let's say, if it's down in value, it's going to try to stay in business as long as possible to continue to recover. And so this OPM setup does not necessarily represent the reality. It might represent the reality in a situation where you have a controlling investor, the fund is coming to a close, and so that controlling investor might legally be required to dispose of their position. But those situations are not present as frequently as OPM being used in its, let's call it, naked form. Now, there are observations that time to exit and volatility is understated. And I kind of mentioned that in the first point I made. The time of exit here is something that routinely is used almost as a rule of thumb, 3 years to exit. In our practice, we have been more detailed about asking our clients about specific exit scenarios, and we already had those exit timing adjusted towards those considerations. But on average, the expectation that this guidance gives us is that the time to exit and volatility would have to be higher because it'd be more consistent with economics of the startup. Now, again, the OPM is the closed form solution, and so it does not consider path dependency. It does not consider future financings. If you invested in seed series of financing and you want your company to succeed, success typically means more rounds of financing and many rounds of financing before company exits. By the time you're done with another 5 rounds of financing, your seed shares actually valued very close to the common stock. And so again, the using OPM analysis at that stage with a limited term is not really something that reflects the reality of what's going to happen in terms of the relationship of seed value and common stock value. And of course, it doesn't catch path dependency that we mentioned before, where depending on how a company is doing, management makes different decisions. Now, how do you fix this problem? So the problem, the guidance mentions simulation analysis, Monte Carlo. So of course, if you want to pay 5 times more for an evaluation, you can ask evaluation specialist to do the Monte Carlo simulation. The problem with that, the way at least we see it, is that Monte Carlo simulation, what it creates appearance of sort of careful, detailed analysis about future rounds of financing. There's so many assumptions, unobservable and hard to support assumptions that go into this analysis that if you go past, 1 round of financing, we believe that it's not really informative, this type of analysis. And the guidance actually recognizes it and doesn't push Monte Carlo here. So nothing to worry about. They introduce another methodology where they value preferred stock on the basis of debt-like preferred plus, it says update here, plus upside. I apologize for typo. So debt-like preferred plus upside. So the debt-like preferred, debt-like portion is the part that has to do with liquidation preference itself. And then the upside, if that preferred gets to participate in the upside when it converts into common stock. This methodology, there are pretty, in my view, significant structural questions about this methodologies. And then the authors of this guidance, they actually recognize that this method is not going to be a primary method. It's not going to replace OPM. And they, quite frankly, want to have more time to see how method is applied in in the real-time situations before they start making any recommendations, strong recommendations around it. So the first and very simple step, and I think it can resolve many situations, it's increasing the term of increasing the OPM term and increasing the volatility in that OPM. So these two assumptions will result in the lower value of the liquidation preference and therefore the higher value of the common. And it may actually be able to resolve a good number of situations without getting into other complexities of this analysis. Now, adding a scenario analysis, a scenario on top of the OPM is something that is recommended in the guidance. So before the guidance, the typical approach was that we're going to use the OPM, and I'm going to call it naked OPM. We're going to use the naked OPM, nothing else, up until the point where a company is just about to go public or it has an LOI to be sold for a significant amount of money, but not before that. Now, guidance is telling us that we may have to start adding this positive scenario much earlier and way before there's any visibility towards that exit. The reason for that being is, again, the traditional OPM analysis gives too much weight to mid-range scenarios. In other words, it overstates the value of the liquidation preference. And so if you introduce the scenario that really deals with or calculates value of common stock based on common stock equivalent calculation, in other words, the fully diluted number of shares in the denominator, no OPM, then that would reduce the reliance or reduce the value of the liquidation preference. And then, of course, more weight to the secondary transactions that essentially would do the same thing. Now, again, the guidance doesn't give you any specific table or chart or grid that will tell you exactly when to start using the scenario analysis or how much weight to give to the scenario analysis. But they do emphasize this calculation that essentially measures implied preferred liquidation preference yield or implied yield on liquidation preference. Every OPM model automatically bifurcates the value of the preferred tranche, bifurcates it between the upside and the value of the liquidation preference. And so when you have this present value of the liquidation preference, you can essentially calculate the implied yield based on the term. So if you're looking only at the liquidation preference as the contractual obligation of the company, then you can say, okay, today we raised $10 million in financing. OPM allocates $8 million to the value of liquidation preference and to the value of this contractual obligation, then another $2 million to the upside. Then you can use that in many ways similar to the zero coupon bond and say, okay, so if you go from $8 million to $10 million, which would be your liquidation preference right at the exit over a certain term, then there's an implied yield. So let's say it's 10%, 20%, or 30%. And so they do this calculation. So OPM will automatically spit out this calculation. They look at this calculation of the implied yield and they say, okay, is this yield in line with what you expect to be the yield on the venture-backed debt? And in many cases, when you do a traditional back solve, this yield is going to be relatively low. And so the question would be, okay, your model is overstating the value of liquidation preference because you don't get that much yield, right? And so therefore, you have to go back and kind of work with your model. Now, guidance does not tell us what those yields should be. I don't believe it even provides any reference to the empirical studies of what the yields are. But the starting point might be triple C rated yield bonds. There are also empirical studies out there, but essentially anything that's approaching 20% or maybe above 20% is probably the desired amount that auditors want to see in this calculation. And if you start getting something less than that, then there might be question marks. Now, just literally 2 words about DLOM, kind of technical. So the guidance gets rid of protective put. Protective put is one of the models that was used to calculate the DLOM. There are 3 models. They all run based on term and volatility, and risk-free rate. Protective put is one of the 3, typically gives you the highest DLOM. And many reports actually rely on protective put as the only indication of DLOM. So this model is gone. But there will be other things that would compensate for, for this loss, so to speak. Differential DLOM is no more. So differential DLOM is this chimera that sort of came to be over the years, but really was not consistent with the logic and the thinking of the people who wrote the guidance. And I was actually at one of the conferences, and when presenters who participated in writing the guidance asked the audience of how frequently do you use differential DLOM, about 80% raised their hands. That was not technically a correct thing to do. Even though large audit firms frequently push for something like that. And so now guidance specifically tells you differential DLOM no more. That's one of the factors that will make up for the lack of protective put calculation. The guidance is telling us that if you do the IPO type exit scenario, then you typically would not use DLOM for that scenario in the analysis. So kind of closing thoughts. But once again, the guidance generally is pushing your common stock value to be higher. But it's not a dramatic push. And it's certainly not something that they would expect to see on your next valuation necessarily. So there is an understanding there has to be consistency in the valuation, and simply changing methodology or changing the guidance should not double your stock price. But also the guidance really puts a lot of weight on observable inputs. And so, for example, if you are in the industry that is, let's say, being negatively affected by some sort of economic factors, they definitely want you to incorporate that in the valuation. So, and that's where the calibration comes in. You may calibrate your model to this round of financing 3 years ago, but if the company wasn't performing great, or maybe the market is down, then you can calibrate those multiples down actually over the course of this time. And so the emphasis is, again, use what you can see, not what necessarily your theoretical model tells you. And so first, I'm going to talk about situations where there is no secondary transactions. Those are the majority of the situations. So amended OPM, high, longer term, higher volatility, the first simple step to take. Now, if your yield calculation, implied yield calculation, comes too low, then you might consider introducing the high value exit scenario, let's say an IPO scenario. Again, even though it's not even on the horizon yet. In one of the presentations I was sitting in, one of the leading or firms out there, audit firms out there who participated in writing the guidance, they flagged this approach, so not all scenario analyses are the same. And so just because you see scenario analysis doesn't mean it's a good thing. In fact, there is a pretty prevalent use of the down scenario analysis, where your second scenario is not a positive scenario, but negative scenario. And so when you have OPM plus negative scenario, you can manipulate assumptions such that you come up with a very, very low price of the common stock. Now, auditors have pretty strong words about it. And so this is something that I would expect be very difficult to press or get auditors signed off on. And again, it conflicts one of the key tenets here of this guidance. It's the idea here is that the liquidation preference cannot be so valuable. Liquidation preference, and that's pretty much the main and only economic factor that brings about the difference between the preferred value of the preferred stock and the common stock. So if you increase that gap, you essentially increase the value of liquidation preference. And so that's not what this guidance wants you to do. Now, the guidance actually talks about valuing debt on a fair value basis. This is something not necessarily new, but it's too early to say, but typically in the 498 analysis, you take the debt value at the book value, and you just use that. But the guidance really tells you to think more about fair valuing it, which would potentially increase the scope of engagement. We talked about implied liquidation preference yield, and DLOM with higher volatility and longer term, we don't see significant change to the DLOM as based on what the guidance is telling us. Now, if you do have secondary transactions, they do expect you to take a deep dive into all of them and kind of go one by one and understand the background and the motivation and all that. They do want you to increase the weight to those transactions substantially. So if before you can get away with 2%, 5%, or this argument that I'm going to give it as much weight as there is a number of shares was traded relative to the fully diluted number of shares, they now want you to start much higher. And so recommendation here is to actually run it by your auditors before your report goes to the board. And then, of course, they want the better reconciliation between the secondary pricing and the model. So they don't want to they don't want you to just give more weight to the secondary transactions, but they also want your 498 model to make sense. And make sense means that it's closer in value to your observed secondary transaction. So with that, I'll stop and see if anybody has any questions. So one of the questions, does secondary transactions include company buybacks from existing shareholders? Yes, absolutely. So secondary transaction is essentially there's primary transaction, there's secondary transactions. The primary transaction is the first time security is being issued. So let's say it's a financing round. Secondary transactions is everything that happens afterwards. And so you might have tender offers, you might have transactions between investors, what have you. So if securities already were in existence and somebody's trading those securities, that would be called a secondary transaction. Another quick question here, would the recorded session be made available post the call? And yes, we can make that available. Yeah, so another question is this suspicious down scenario, how to find out if that's what is being done in my 498 evaluation. So it's a good question. We've seen one firm kind of using a lot of that. But typically, you, like I said, have to really worry about the difference between your concluded value of the common and the preferred. And so typically when we see this down scenario being used, you see common stock being valued at 10% of the common, or 20%, 10% of the preferred, or 20% of the preferred. And that intuitively seems too low. But anyways, if you can always ask a valuation specialist to explain that. And so if one of the scenarios is OPM and another one is the downside scenario, then typically you have to press your valuation specialist a little harder. Why is this gonna be able to withstand the scrutiny? Also, thank you very much. I'll finish here, and please feel free to reach out to me directly with any questions. And tomorrow we will also circulate this presentation for your perusal. Thank you very much.